So Cathie Wood of ARK Invest is saying the Fed is risking an economic bust, and Jamie Dimon of JP Morgan is saying we could go down another 20% from here. Hey everyone, this is Chris, and this is your daily uncut news. So I got to start with this, guys. It's the whole Cathie Wood thing and what Jamie Dimon is saying, and kind of what's frustrating about this whole system is I feel like, and this is truthful, is either people are too stupid to tell you the truth or they know the truth, but they're frankly just been lying to you all this time. And it's really frustrating because there's just so much bad information out there. And I try my best to show you guys, where we are, where we're going, that kind of stuff. And to be perfectly frank, because I tell you the truth, it's not that popular. People prefer to live in fantasy land. And it's unfortunate because, now that it's too hard to hide what's really happening, then suddenly, okay, now we'll tell you the truth. So that's just what's going on. And I mean, when the CEO of JP Morgan, right, when they make money off people investing and they make money off deals, they make money off essentially managing your money. When he's coming out in the media and saying, "Hey, we could go down another 20% per here," this is not by like some random statement or random mistake, right? This stuff is planned in terms of they're very careful of what they say in public because they manage people's money, and the big money is just like, "Hey, what's going on over there, JP Morgan? What are you doing?" But to be honest, guys, though, I heard from a lot of friends on Wall Street that people were getting out, a while ago, and I mentioned to you guys as well. But it's not something they would necessarily talk about in the media because it's not popular, right? People want to hear how they're all going to be rich, and the whole Cathie Wood thing is pretty ridiculous, actually. Basically, she wrote a open letter on her website. You can read it, but it's not really worth your time, to be honest. But the basic gist of it is she's like, okay, I'll read the key language here. In this summary, we delineate first the upstream price deflation, and that is likely to turn into downstream deflation. Then we focus on two variables: employment and headline inflation, upon which the Fed seems to be making decisions. In our view, both are lagging indicators. So the basic gist of it is she thinks the Fed concentrates too much on inflation and concentrates too much on unemployment. And she's making the case that because commodities have fallen down in price, that we're facing a deflationary environment. The kind of crazy thing about this and why it's crazy is, we have massive inflation and we need some deflation, and she's trying to say it's bad. The issue is that, with rising interest rates, all of her sort of speculative plays and stuff like that, because essentially the cost of money goes up, really, really affects all of her crazy growth picks. And, remember, she's the person who was saying that Bitcoin's going to go to $1 million. So it's kind of crazy. It is what it is. And it's frustrating because like I remember there's like channel after channel that would basically just reiterate whatever she said and just basically be ARK Invest cheerleaders. And I'd be curious what those channels are saying now. You guys are in the comments if you guys write these things. But I pointed this out a long time ago, and it is what it is. I talked about this stuff. I don't know. I just like I said, I just find the system be really corrupt. Either people are too stupid to know the truth, or they're frankly smart enough, but they're just lying to you. And it's like now to finally come out and say, "Hey, everyone, things look really bad," but it's like it's been obvious for quite a long time. They just can't hide it anymore. And so this is sort of what Jamie Dimon is saying here. The likely place you're going to see more crack and maybe a little more of panic is in the credit markets, and it might be ETFs, it might be a country. It might be something you don't expect. This is Dimon in an interview to CNBC. If you make a list of all the prior crises, sitting here would not have predicted where we came from, though I think you could predict this time that it probably will happen. So, and you talk about recession. So if I was out there, I'd be very cautious. If you need money, go raise it. It's so ridiculous. So basically, like, they're getting a bunch of clients saying like, "What should I do? What should I do?" And he's like, "Well, if you need the cash, I wouldn't leave the money in the market right now." That's literally what he's saying, because that's what he's advising clients. It's because they're getting these conversations, but the problem is why it's so corrupt is you should be telling people this stuff a year ago or whatever, right? Not like after it's crashed, 30%. Dimon said the S&P 500 may have a ways to go. That's a quote. In its decline, and another quote, and it could be another easy 20%. The index is already down 25%, you guys know, this year. And then he's saying the next 20% will have much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it. And basically, it's the tightening of the credit markets. I'm going to make a more detailed video if I have time. I'll try my best. But the basic thing I want to talk with you guys about is Ben Bernanke got the Nobel Peace Prize for economics. And if you don't know anything about this whole thing, it's sort of he and the Fed were all about printing money and essentially bailing out the banks, which is a controversial thing after the 0809 crisis. If you guys lived through this thing, you'll remember, and you also probably remember Occupy Wall Street. Which I very much remember. I didn't go because I was out of the country. That's how I felt about the whole situation. I'm out of the country again, as you guys obviously know. We're in Korea, and I've been telling you guys, the dollar's strong, and if you want to live abroad, if you want to travel, now's the time to go. I don't think the dollar will weaken, anytime soon, because it's not like the dollar is just going to suddenly crash tomorrow. It's not going to be like that. And one of the things I want to point out to you is sort of, I want to show you a little bit of history of just to compare companies, and something that's really interesting to look at. Because I know people want to just say, hey, Chris, well, what about the market, stuff like that? I mean, I get it, guys, but I just want you guys to understand the whole system, because if you don't understand this main system of corruption of what, information, stuff like that, it's going to be real tough for you to be successful. I mean, you got to just learn to look at numbers and have a general sense of where you're at, and you'll do much better of seeing the numbers for yourself, opposed to just like, oh, well, Cathie Wood told me everything's going to go up, right? And it's just not necessarily always the case. So why am I showing you the Samsung chart? Because I want to show you some comparisons. It's really quite interesting if you look at this stuff. So Samsung's a good company, right? You guys know this. Who doesn't know Samsung? And you can see over time, the stock's mostly gone up. It's done okay, right? The problem is, though, is you got to look at back in history, and you can see this one here. This is Sony, because they've been public longer than Samsung. That's why the charts are different. But you can see here, nothing lasts forever. In 2000, you guys can see that Sony had a big spike. And actually, during the 90s, there used to be a ton of movies about how Japan was going to take over USA. There was lots of protests. Actually, in the 80s, it was a lot of protests. But the one I'm thinking about in particular is, I want to say it was called Rising Sun. It was Sean Connery and, what was the other dude? It's a dude in Demolition Man. Wesley Snipes. Sorry, brain fart for a minute there. But the basic idea, though, there was a fear that Japan was going to take over and all this stuff. And it's interesting because you can see how the dot-com bubble really deflated Sony. And for a long time, Sony was a major company. And it's not like it's disappeared, right? We still have Sony PlayStation and stuff like that. But the Walkman in the 80s was massive for Sony, and they had a huge recovery, the Japanese economy, I mean, after World War II. And I'm sure you guys know this, so if you know history, much of the world was destroyed. And actually, Japan came out ahead after World War II, and then Korea rebuilt also too. But Korea was a little bit later because the Korean War was after World War II. But I just wanted to show you this is Sony used to be just a powerhouse in terms of stock and of growing, but the dot-com bubble really deflated that. And it's interesting too, because this is another example of a tech stock. This is Alibaba, which was an internet darling for quite a while, right? And you can see here, I think it peaked around, I don't know, 2021. It's an interesting company because people, would just assume it's going to be Amazon forever, that kind of thing, online shopping. But the thing is, what I'd warned people about for a long time was a couple. One was the Chinese Communist Party, and the other one was the slowing growth of China, both economically and birth rates. Actually, is a real problem. So this is why when we go through the news, you want to understand the full picture, not just look at a bunch of charts. Even though I said yes, look at numbers, I wasn't lying about that. But the thing is, you got to kind of take everything in as a whole, right? Not just isolated bits of information. Apple's an interesting one when you compare it to, like, these are all major companies. It just basically had this massive boom. And if you saw my video, basically a brief history of economic policy, please take a look at that if you haven't seen, or I could say brief history of crashes. That's a better way to look at it. It's a fun one. You'll find it. I titled it Quantitative Tightening. Just take a look at it for that video if you haven't seen already. But basically, Apple made some big moves after 0809 in terms of stock price. The same way a lot of stocks, the same way that Bitcoin, Tesla, stuff like that. It's not by mistake, right? Our whole system was built on essentially bailing out the banks, printing money. And yes, we had economic boom. So in that regard, if you want to say that Ben Bernanke deserves the Nobel Prize for printing money, go for it. But this is sort of what we're kind of in this weird era of, like, okay, so we're going to print again. Is that what we're going to do? Or are we serious about not printing anymore? And are we actually serious about, say, deflationary type of things? Even though Cathie Wood and her team will be complaining about that. But, you got to make that choice, right? Do you want to keep living in a bubble forever? Or do you want to, try to control that? you theoretically can live in a bubble forever. It is possible. I just want to let you know, as long as you know we're in a bubble, it's like kind of the Matrix. It's like you can live in the Matrix forever, but it's not real. um, if you take a look at this, and this is always an interesting one to take a look at, is the PE ratio of Apple is around 24. I think forward P is roughly the same in the mid 20s, that kind of thing. Historically, though, say in the mid teens, like 2014 ish. Apple is trading around, 12, 13, 14 PE. If you guys don't understand this is the price of the stock compared to how much the company earns. And you usually want to think about like what is a fair price of is essentially, does your earnings growth, does that exceed your PE ratio? So the general gist is, if we're going into, say, a recessionary environment where we maybe have negative GDP growth, do we think a company like an Apple is going to trade at, say, 25% or 24 PE? But I mean, like, are they going to grow their earnings 25% a year or something like that? And it's interesting because when you look at like something like a Samsung, when their PE ratio is like 8.52, and yes, it's not exactly apples to apples, but I just want you to show that this is not like a fake company. Samsung's a legitimate company. You guys know that. Or even like Sony, which is, I guess, unprofitable, which is really interesting to if we ever dig through Sony numbers, because they don't have a PE ratio. I find that very interesting. Because I haven't deep dived to Sony for a while, so that might be an interesting one to do in the future. The thing is, like, most people, and this is how it is, guys. Most people on YouTube don't care about these kind of stuff, so that's why you don't say do it. Because if you do it, it's like people are like, why are you making that stupid video? And I promise you guys, like for example, I was making videos about resume writing and stuff like that, but people aren't interested in that stuff because they don't think it's happening. But I'm telling you, the recession is a real thing, and you want to be prepared. And I'll show you some things at the end, which will make sense why we're talking about it now. If you take a look at other charts, 2-year Treasuries at 4.3. It's tough for stocks when you can take something safe and guaranteed. One things that you always want to do when you manage your money is you diversify, put your things in and put your stuff in different things, and you want to sort of determine how much risk is appropriate for you. According to this is the Buffett indicator you guys can see here. So what are we at now? We're about 20% above the trend line. And so, generally speaking, you think of the market like a rubber band. It goes up too high, it'll eventually come back down. It goes down too low, it'll eventually come back to the mean. That's the general theory of it. And it's not a crazy theory that, things tend to trade upon their mean. This compares the value of the market to the GDP. So, how are stocks valued compared to how much the economy is growing? And we shrank for a couple quarters, and we'll see where we end up in the next GDP read. We'll see. I'm looking at this. This is your S&P 500 PE ratio, this is a good way to look at it because you're thinking, okay, how many standard deviations are we from the mean? Because again, that's the idea, is that the market trades along the mean. This would suggest that we're 32% above the average. If you want some raw numbers, we'll take a look at that. You can see here the S&P PE ratio is 18.26 as of today. The mean is about 16. So we're a little bit high, and we check this stuff because you want to know kind of where we are, right? Because people are always like, hey, where's the bottom? Well, either stocks need to come down in price or earnings of companies need to go up. So stocks are definitely coming down in price, but we're going into earnings season. We're going to find out. We certainly could get some prizes. That is a real thing. I don't see it happening myself. But you never know what they're going to say. I have a feeling, though, since we're already being kind of warned, is that companies are like, hey, everyone, we're a little bit nervous about the future. And I think what scared people was essentially, there's a couple things. One is it just seems like the war in Ukraine may never end. It's just what it feels like. It doesn't mean it's going to happen that way, but I'm saying it's just what it feels like as it's escalating today. And the other thing is, too, is the unemployment doesn't seem to be going down like it, quote, should be. It depends how you want to talk about it. The thing is, I noticed this, and this is sort of why I was telling you guys that no one wants to tell you the truth. I've been telling you guys for a long time that I keep saying that unemployment's going to go up. I've been mentioning this for a while, and now they're starting to tell you the truth. This is sort of like, hey, today everyone's starting to tell you the truth. It's Monday, and let's tell everyone the truth because we can't hide it anymore after those unemployment data came out. Was it last week already, I guess? So you can see here the headline, Fed Evans says fighting inflation is top priority, even if that means job losses. And does a quote, if unemployment goes up, that's unfortunate. If it goes up a lot, that's really difficult. But price stability makes the future better. So basically he's saying you're going to lose your job. It's going to way that has to be because we just got to have a control on prices. And the reality is that if you guys take a look at this, this is a history of essentially unemployment. We're at around 3.5% at the moment. And if you go back in history and just look at the chart for yourself, This is why I say unemployment could go anywhere from to say 5 to 10%, because we've seen it before. It's not like we haven't, right? I'm not just making random numbers up. And so, do I know exactly where it's going to go? No, I can't predict the future 100%. It's just too hard to tell you how many companies are going to fire people and which companies exactly. But I do know there'll be slowdowns. That's why I've been always show you guys like, oh, this company's slowing down, this company's slowing down. It's probably going to hit tech first, as we've talked about several times. But I keep looking for 5 to 10. The Fed originally was saying 4.5 next year and talking about unemployment. But now they're starting to change their language a bit when they're saying this kind of stuff. So this is why I always say, the best way to ensure success is to develop your skills, to make sure you have jobs that pay you, because you always want to be sort of useful to someone, valuable to someone. If you have skills that aren't valuable to people or that you're easily replaced, it's a tough time, because you can't count on the markets going up forever, especially when they started the language of quantitative tightening. So this is sort of a thing that's been going on. They're raising interest rates. And now you have Cathie Wood complaining about a deflationary environment and warning that things will go economically bust. And Jamie Dimon's even now saying publicly we could go down another 20% from here. So that's what's going on. And if you want to stay updated, I do appreciate you guys joining us for this daily uncut news.